Investors Chronicle.
Welcome to the Investors Chronicle Companies and Markets Show. It's Thursday, the 20th of June. It's the summer solstice, and the weather has started pulling its weight just in time for the summer sporting calendar as well. So we will start this week by looking at two of the UK companies that stand to benefit from these trends. That's pubcos Youngs and Fuller Smith & Turner, both of whom have reported full-year figures over the past week. Chris Akers will be joining us to run the rule over the pair momentarily. Then we turn to bigger beasts, specifically conglomerates and other big corporates, many of whom are again engaged in the process of slimming down and selling off parts of their businesses, often at the behest of activists. Jennifer Johnson is here to discuss her cover feature, asking how well breakups work for all parties. Finally, in the week when Nvidia became the world's largest listed company, we look at the funds that are capitalizing or trying to capitalize on its share price success, and ask some probing questions about the imbalances in the US market. Funds editor Dave Baxter will talk us through all that later on. We begin, though, with pubs. Chris, welcome to the show. How are things up in Edinburgh?
It is strangely warm, but it's just started raining, so it's just about typical.
Yeah, I was going to say, yeah, conforming to the stereotype, but maybe I shouldn't linger too long on that because the weather is improving everywhere, and we're going to talk about pubs in relation to that. We're going to start with two companies who are actually based quite far away from you, mainly in the south of England and London. That's Youngs, as I say, and FST. Let's start with Youngs. Their figures out in the past couple of days. How did the results strike you? And also, we'll come to the big acquisition they made a few months ago as well.
Yeah, so I'd say this was a fairly resilient set of results from Youngs. So it posted a record adjusted pre-tax profit of just under 50 million, revenue growth of about 5%, and that was boosted by the acquisition you mentioned of City Pub Group, which it acquired in March. On a statutory basis, profits slid though by about 40%, down to about 21 million because of transaction costs from the deal, and it also had some chunky revaluation and impairment charges as well. I think overall, I'd describe it as a resilient set of annual results.
Let's talk about that deal, City Pub Group. It hasn't gone down that well with the market. The shares are down, I think it's about 10, 12% last I looked since that deal announced, I think October at the time of the interims. But I think it's fair to say you're relatively optimistic on what it could bring the business. How do you see that deal working, or what do you see as its potential benefits?
Yes, so as you mentioned, the shares are down by over 10% since the acquisition was announced last year, and that does highlight some market skepticism about the deal. I think one concern is leverage has shot up as a result of the acquisition, but as I argue in the piece, that looks like it's going to fall pretty quickly back to normal levels. So I think the acquisition is not just about scale. So it's brought in 55 pubs and about 240 bedrooms from the deal. So it's not just about that in scale. It's about how quickly the company's managed to expand its estate. It would obviously take a long time to have boosted the estate by such a volume otherwise. I think the City Pub sites also fit in pretty well with Young's premium focus. They tend to be in high-end towns and cities, premium locations. And looking at the trading results, the impact on growth is also pretty clear. The acquisition drove managed house revenue up by over a quarter in post-period trading, and also delivered over a third of the total revenue growth in the year. So I think it makes sense from both a strategic and financial perspective.
Yeah, most of these pubs, I had a quick look at the map they provide at the time. Most of them are around, again, the south of England, a couple in East Anglia, but more or less the similar kind of location, so it knows what it's getting, you would assume there. Potential, I think, for some margin expansion too is what they've been saying as a result of the acquisition, so that does tie in, as you say, with the higher end side of things. And Young's margin is pretty good anyway relative to the industry operating margin of around 15%. The growth, though, in recent weeks or over the past year as well, the like-for-like growth in these results, 3.4%. So when you factor in inflation, it's below inflation, clearly. Does that show the need for acquisitions? Alternatively, if you look further back, their like-for-like growth the year before was pretty strong. So it's potentially just more of a normalization there, and they're actually still on a good footing overall. How do you see it?
Yeah, I think it's fair to argue that we are seeing normalization rather than a drop off in trading. I mean, on the face of it, 3.4% below inflation doesn't look great, but as you mentioned, this comes against pretty tough post-pandemic comparatives. But either way, I think the acquisition of CityPub makes sense in a growth context, and the company is really trying to boost growth. So I think I would argue we're seeing normalization rather than a slowdown. But again, either way, the CityPub deal looks like a good bit of business.
Mm. And the valuation pretty attractive at the moment in your mind too, certainly relative to some of the listed peers.
Yeah, exactly. So the shares are trading at about 7 times enterprise value against cash profits. That's a very cheap valuation when we look at freehold pub space. But it's not just about valuation. As I mentioned in the piece, we also like Young's premium focus, as I mentioned, which links into the wider premiumization trends across the alcohol sector. And again, I think the new acquisition makes sense. It's a combination of valuation and other factors, which is why we're still bullish on the company.
One thing we're going to talk about momentarily is the sporting calendar and how that might help. And having belatedly tried to book some establishments for the England game this evening, I can tell you that almost all Young pubs in London appear to be fully booked for that. So there's definitely going to be a temporary uplift. Let's turn to Fuller Smith and Turner, though, first. Their figures out, I think, end of last week, their own full-year figures. Like-for-like sales pretty strong there, albeit coming from a lower base. But how did the figures on the whole strike you in the case of FST?
Yeah, I think I'd also describe Fuller's results as pretty solid. So the revenue up 7%, pre-tax profits up 40%, like-for-like sales growth of about 11%, looking pretty good, as you mentioned. And it did post some impressive figures across its sales streams. So foods like-for-like sales up by 15%, drink by 10%, and accommodation by 8%. So pretty solid. But what I would say is, while the like-for-like growth was a bit more robust than at Young's, the valuation is pricier. So the shares trade at around 9 times enterprise value to cash profits, which is something to bear in mind.
Mm. And what about, in FST's case, the operational or the strategic way they're approaching their business is quite different. And you look at Young's, you just made this big acquisition. FST are buying back shares, some of the A shares they issued during the pandemic, dividend going up as well. So diametrically opposed approaches in some ways.
Yeah, so there's obviously different strategies going on here. Just for background, Fuller's issued 6.5 million shares back in 2021 to shore up its balance sheet during the pandemic, and is now making very good progress to buy back the same number of shares. It's also bringing in cash for investment through disposing of some sites. It's selling around 40 non-core pubs, and it's also disposing of a central London site, which would bring in about £20 million. So, yeah, different business plans at the two companies.
Mm. Well, summer is here, calendar-wise, weather-wise. What do we think about? I mean, that is always an impossible thing to work out, of course, for pubcos and how affected they'll be by whatever the weather turns out to be. But what do we think about, the summer of sport, which these companies like to talk about? I think the Young's chief exec saying, Wimbledon's going to be a big thing for us. And they do have about a quarter of their pubs in southwest London, so quite near Centre Court. But equally, Wimbledon happens every year. The Euros clearly happen every 4 years, interspersed with World Cups. How do you see these things affecting the share price over the weeks and months ahead? Is it the case that investors will see a trading update in a quarter's time and see a big boom based on sport and they think, oh, that's great? Or is this something that investors really should be factoring in every couple of years at this point?
Yeah, it's hard to say in terms of what the actual impact will be when it comes to updates over the next few months. I think clearly the sporting calendar over the summer will be a good thing for the pubs, just in terms of getting people through the doors. We discussed a bit before the call, Dan, about growth slowing for both companies post periods. I think it's important to mention that is partly to do with wet weather and the timing of Easter.
Mm.
But again, slowing growth. So big sporting calendar ahead will be good news in that context. But I think it's important for investors to think about the wider picture. As I mentioned earlier, we are now in a stage of normalization, really, after the post-pandemic reopenings. And yeah, that's the thing to focus on. There will be a short-term boost, you would think, from the summer ahead, but the wider picture is normalization rather than a slowdown, as I mentioned earlier.
Yeah, I suppose the thing under the radar relative to these high-profile events to look for this year is how the costs and how utility costs hopefully continue to fall back, because across the sector we have seen in some cases like sales are up pre-pandemic, but margins pretty much across the board are still about 150 basis points below in most cases from my quick check earlier. So maybe there's some potential for normalization in a better way in terms of margins if those costs fall. But we'll keep a close eye on them, of course, as the weeks and months progress as we go through the summer. We're going to turn now, though, to our cover story this week, which is about company breakups, conglomerates, bigger companies in general, companies with lots of different divisions. Jen, you wrote the piece. Can you discuss, first of all, the thinking behind the feature? Because this is a subject that comes up fairly sporadically about the health or otherwise of the conglomerate.
Yeah, I think it's every couple of years you're going to get some article somewhere proclaiming that it's it. Finally, the conglomerate structure is sort of done. Investors have had enough. Companies are looking at other ways of kind of structuring themselves. But I suppose the question I wanted to answer with the feature is whether the kind of formation and dissipation of conglomerates is a cyclical trend, really. Do investors start demanding that companies sell off non-core or underperforming divisions when the global economy slows down? Conversely, do big companies sort of turn acquisitive when debt is cheap and business is booming? So the answer isn't kind of a cut and dry yes or no, but it is very clear that the conglomerate structure goes in and out of fashion and probably isn't going anywhere.
You can see some of this trend from the 1960s onwards, I think, in line with economic cycles, as you just suggested. There is some evidence of that happening, certainly in the rise of the conglomerates to begin with in the US in particular.
Yeah, I think there are a couple of companies that are quite instructive to look at historically to sort of plot the life cycle of conglomerates, if you will. One of them that I mentioned in the piece is DuPont, the sort of chemicals giant, which was incorporated around 1900, existed for about 100 years before that. And explosives were actually its primary products. At one point, it effectively had a monopoly over the gunpowder market in the US. But that was before antitrust regulators sort of came knocking and forced it to divest part of the business in about 1912. And at this point, it started building up a huge position in General Motors, as well as sort of using the byproducts of its explosive manufacturing to make certain plastics. And now we probably think of DuPont really as a materials business. It's responsible for things like nylon and Teflon and all of these other products that are really kind of embedded in everyday life. At one point, also owned the Conoco Oil Company, which it spun off in 1999. So this is a company that has sort of historically been successful in reinventing itself and expanding into adjacent lines of business. And other conglomerates kind of follow this sort of boom and bust model. And, you see the antitrust factor comes into play quite a lot. Companies break up and then, they kind of reach a sort of point of saturation in the markets that they're operating in. They can't get any bigger. So then they begin this process of diversification all over again. And, it's not happening in all sectors simultaneously. It's sort of who has got the cash to hand and needs to continue to expand. And I think we'll probably touch on the fact that that the tech companies are looking like they're in that position a little bit later on.
That's probably a good point about it being a bit more dispersed, because as opposed to the narrative I was alluding to there, where you had 1960s low rates and these conglomerates forming, and then, as you say, antitrust a couple of decades later and poor performance starting to lead them to split up. Maybe it's more of a case-by-case basis nowadays. That said, some of the headlines last surfaced a couple of years ago when you had the coincidence of three companies announcing they were going to split in fairly short order: GE, Johnson & Johnson, and a Toshiba in Japan. You've got DuPont now potentially going through a similar process soon. Can we say a bit, though, about those trends and what's happening there, but also in the consumer staples world, where there are some not quite breakups of companies, but certainly there have been some spin-offs that we know about, and there have been some divisions as well that are potentially looking under threat from activists.
Yeah, so I think the argument for breakups on the industrial side of things, so we're talking about your DuPonts and your GEs, the kind of the American industrial titans, the breakups there kind of tend to happen because it becomes difficult for investors to understand and sort of properly value these highly complicated entities, and they only end up being as strong as their weakest divisions at a certain point. And then when a conglomerate gets split up into a pure play entity, it's easier for investors to, say, compare them with sector peers. There's this phenomenon called the conglomerate discount, which refers to the tendency of markets to value conglomerates at less than the sum of their parts. The thinking is that splitting up eliminates this discount, and that's the kind of desire to do that really seems to have motivated the industrial breakups that we've seen in recent years. Pharmaceutical companies haven't necessarily been breaking up to eliminate a discount per se. It makes sense for them to divest things like their consumer health divisions. Obviously, we saw that here with GSK and Haleon 2 years ago, so that they can generate some cash to reinvest in pharma R&D, to make sure that their pipelines are properly stocked. And I think it's become clear also that consumer healthcare is much more a consumer business than a healthcare business now. So ultimately, it's about focusing on what these companies do best. At the same time, activists seem really keen on company breakups at the moment, particularly in the consumer sector. We've seen this with Reckitt a little bit recently. So there are always a number of factors in play here when deciding whether these companies should break up. I guess the thing, if you're an investor looking at a company that looks to be on the cusp of one of these splits, is to try and evaluate whether there is value in this, because it's not always the case that a spin-off equals success.
Quite often the spin-offs, they have a complicated afterlife, whereas certainly in the activist case, though, and for existing investors, they'll be hoping that the company which has spun off the new business will fare better on its own, which can happen in some cases, but the spin-offs themselves can have a choppier start to life, sometimes just because of the way these deals are structured.
Yeah, there was some data on this from Bain, the management consultancy, which analysed 350 public spin-offs, and they found that half of them failed to create any new shareholder value 2 years down the line. 1/4 then of this sample group wound up destroying shareholder value in the process of separating. So part of this is obviously because, as you've alluded to, the actual process of breaking up can be very difficult. You've got to figure out how close you're going to remain to your former parent company. You know, you might end up having to sever key supply chains or overhaul certain IT systems and processes, and these things can take time. Meanwhile, investors also tend to be wary of companies with no reporting history. So all of these factors can combine really to hold a spin-off back initially. That said, there are notable exceptions. The 3 companies formerly known as GE have done really quite well since going it alone recently. So I think the key thing is that you have to, though it can be difficult, really look at how successful these businesses are likely to be on their own. Are there kind of any structural overhangs, any issues, whether it's litigation or, are there any kind of ongoing problems that might only be magnified when a company is sort of standing alone?
Clearly, activists are going to keep pushing for various breakups or spin-offs or what have you for as long as there is company underperformance, which will be forever in some areas. You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. But why don't we talk about tech to finish? You mentioned big tech earlier, and that perhaps ties in with the whole antitrust argument in a way, insofar as one thing we were talking about the other day was just how some of these conglomerates began because the anti-monopolist regulators effectively almost pushed them into new industries by trying to ensure their positions weren't too entrenched in one area. Could that happen again with tech maybe in future? I mean, it's a very hypothetical question, but that trend has certainly led to conglomerates beginning before with all these disparate divisions that we see now.
Yeah, I think that's very much a live question. And that's, we sort of have seen a lot of the big tech companies start to move in this direction a little bit. Whether or not we can call them conglomerates at this stage, I think really depends on how strict your definition of the term conglomerate is. Is a conglomerate a collection of almost entirely unrelated businesses, or is it, sort of the core business and then offshoots of it? And it'll be interesting to see M&A wise what happens with the kind of Magnificent Seven companies in the coming years. There's definitely been some attention on Amazon as a conglomerate for a while. And when you start to look at, it owns Whole Foods, there are not always what are referred to as synergies between all of the businesses that it seems to be bringing under its roof. And then you have the problem of, are all these businesses eventually going to be subsidized by one of them, i.e. Amazon Web Services? And it's at that point where I think you have this, when you have the large core business propping up other areas, that you start to get the calls, the inevitable calls to break up. So clearly big tech could potentially be approaching that cycle. It's when companies are so large and they have these monopolistic positions and then they start to diversify and then they over diversify, that sort of seems to be the life cycle, really. And that's something that, whether you're kind of interested in buying Apple shares or you're holding the shares of a big pharmaceutical company that wants to potentially offload one of its divisions, these are things that you have to keep in mind, because companies aren't, static entities. Things are going to change over time, and the structure of the business is going to need to change over time. And I think the best businesses are the ones that are kind of able to negotiate those shifts successfully.
Yeah, it's interesting, isn't it? It could go either way, really. You could see, we hear a lot of talk about antitrust, crackdowns in the US. Personally, I think the likelihood of any of the big tech companies being forced to hive off a significant part of their business is relatively small. But at the same time, they may get to a point where they think, well, every single tech deal we do of any size is going to be scrutinized and maybe blocked before it happens. So perhaps we should start looking in some tangential industries, and who knows, you might end up getting some odd conglomerates like you get in the case of some Japanese companies or even some American companies, the kind that another odd conglomerate, Warren Buffett's business, likes to buy sometimes. Maybe that's many years down the line. Of course, for now, all these tech businesses are thoroughly focused on AI and doing what they can there. So we may be a way away from that. On the subject of AI, Dave, we're going to talk about some funds now, because as with every investing podcast and publication at the moment, it's impossible to get through one episode or one article without mentioning the name Nvidia. You've looked this week at some of the funds which are investing in the company, as many people are, but some of the funds which in particular have got really big positions. Clearly, as Nvidia grows, as with all the tech stocks, it takes up more of a proportion of the indices in which it's in, a phenomenon which a lot of people have covered. But I think in the case of some of these funds, some of the positions are still quite eye-opening. What kind of exposures are we seeing, and how is that playing out at a fund level?
So, yeah, there are definitely some really punchy plays on the likes of Nvidia. One investment trust that has turned heads a lot this year, which is up by quite a lot, is Manchester and London. It's not surprising to see how much that's risen if you look kind of at the constituents, because it has around a third of its portfolio in Nvidia. And then to really sort of, ramp things up, it also has around a quarter of its portfolio in Microsoft. So that's quite a chunky play, but investors should remember that it's not alone if you do want to sort of, I suppose, take a slightly more diversified punchy, focus on these two companies. If you look at the iShares S&P 500 Information Technology Sector ETF, not the kind of snappiest of names, but nevertheless.
That tends to be the case with many ETFs.
Yes. Worse if you had UCITS ETF in the name as well. But that has recently had 22.6% of its portfolio in Microsoft. It also has around a fifth in Nvidia and another fifth in Apple. Again, if we look at, say, a NASDAQ tracker, that's actually a bit more kind of restrained, but it does have some quite big tech positions. And then the thematic funds, thematic ETFs that have become popular in recent years, have in many cases been kind of, quietly turning into tech plays. And to give one example that's not actually available on the UK market, there is a Mundy Semiconductors ESG screened ETF, which has a really chunky position in Nvidia. So there is a lot of choice if you're kind of wanting to, maybe try and go very heavily on those stocks, but in a slightly more diversified way than simply holding them both yourself.
Yeah, the important thing, obviously, at a basic level is to make sure you know what is in these funds before you buy them. But the wider question, which all of this begs, is, are these funds a better way than simply just owning Nvidia and Microsoft shares? With Manchester and London, you've got over half the portfolio in two companies. You've got a bit of diversification clearly in the other half of the portfolio. But maybe when you have such large positions, you're better off simply saying, well, I'll own these shares.
Also, I mean, you have to ask, is this kind of optical diversification rather than actual diversification? Because, say, Manchester and London has been very explicitly targeting the AI trend. So, say we do get a sustained sell-off for something like Nvidia, is everything else just going to be roughly correlated to that? And, it's not really going to protect you.
It seems unlikely you'll have much joy at all if Nvidia starts falling fast with Manchester and London. But let's also talk about the structure of the US market, because there's been a lot of attention on that in relation to these questions of how well the AI shares are doing. There was some interesting comments in the FT's very good Unhedged newsletter this morning about how the market is shaping up this year. If you take out since March, effectively, from October to March, the US market, the breadth of the returns were pretty good, were pretty strong. But since March, if you remove the Magnificent Seven or the Magnificent Six, we ignore Tesla's travails this year. If you remove them, you remove some of the semiconductor stocks that have been doing very well, the rest of the index is doing pretty poorly. So even in the case of investors who aren't buying AI stocks specifically, people who are buying the S&P in one form or another should probably be conscious of the way that split has developed, because it is becoming particularly pronounced now.
Yeah, it's interesting. If you look at Nvidia over, I think, their period of analysis, they mentioned that it contributed almost a fifth of the S&P 500's gains, which I suppose people will inevitably call as kind of sign of a bubble and more concentration fears. But it does, obviously has a huge effect then if you're trying to get those big returns from the US equity market.
Yeah. Interesting. Some of the companies which have done worst over the past few months are also US tech stocks. Intel doing particularly badly because people will see it. People are seeing it as a chip loser. It's not going to benefit from AI at all, which is really, in some ways, a strange concept. Is all relative, of course, but also Salesforce has been struggling with its cloud business and things like that. So that leads us on perhaps to another point, which is that a lot of companies that are ostensibly going to be aided by AI haven't been doing very well either. It is pretty much the Magnificent Six and some semiconductor shares, and actually other AI shares haven't done that well in recent months at all. So you may be thinking this is a interesting way to play the trend, and it's just not panning out that way so far.
Yeah, and I guess that's, as always, that's also worth monitoring in the fund space, because we'll see the extent to which different managers do kind of run those winners and double down even more on, a handful of kind of leading stocks, and then whether they get their fingers burned if things do turn around.
I mean, that is the problem for active funds, right, isn't it? It's very hard to overweight or even market weight all of the big tech stocks. That means you turn elsewhere, you look for some alpha, for some gains elsewhere. But if those AI stocks aren't doing well, you're destined to underperform, at least in the short term. I mean, this does all remind me, as it would do, because I wrote the piece only a couple of days ago, of the editorial the leader column this week where I was looking at the UK's relative performance, and a stat I like to roll out for as long as it's relevant, but the FTSE has still beaten the S&P since the rate hiking cycle began at the end of 2021. So again, that's completely under the radar, the fact that the UK market is pretty resilient in that regard. Maybe we can end. Sometimes I like to begin with a quiz question. Maybe we can end with a quiz question.
Oh, no.
I know, putting you on the spot at the end of the show. What percentage of days does the US market go up typically?
Oh, is it going to be
Over what time period?
I think it's just an extended, a long period of time.
So is it going to be a shockingly low? I'm going to attempt to massively understate it and say 27%.
Oh yeah, well you've gone way too low there.
Well, in which case I'll go with 70%.
Yeah, 53%. It's only just more than 1 in 2, but it's really that, that compounding that gives you the overall return. And that reminded me of the other, the famous research showing that there's only even outside of AI euphoria times, it's only really a small percentage of shares that provide the weight of the market return at any one time. So it's not necessarily unhealthy that this market is split in that way.
So it's all going to be fine, is that what you're saying?
Well, potentially, if you get a few bad days, they're going to almost even out with the good days. I saw this I should cite it, is from Bespoke Investment online, an interesting fact. They also compare it to the number of major points that the very best tennis players win, which, even more surprisingly, is also about 53%. Even Federer and Nadal, people like that, they only just win more than 1 in 2. Chris, you're a big tennis man. That might be interesting to you as well. And it basically
funnily enough, someone mentioned that fact to me yesterday, and it's very surprising. I guess it just matters which points you win.
Well, indeed, in tennis, very much about the marginal gains, and sometimes in investing as well, about the small bits here and there compounding over a long period of time. Well, we should probably curtail this chat because we have reached the end of the show. Thank you very much to everyone. Thank you to Chris. Thank you to Jen. Thank you to Dave, and thank you to our producer, Vic Thornton. We will see you next week with another Companies and Markets show.